think I'm live. Am I? I think I'm live. I'm not very sure. I don't even know how to do this. Let me see. Oh, nice name as well. Same could be said about you. But yeah, I really don't know what's wrong with my mic. I've been trying to fix it for like the longest time. I'm just going to wing it this time round. And basically, if not if next week, when I do this again, um, I'll try and get it fixed before then. But the hope is to eventually make this something that I can do more often. So that I think in general, when I cover SoFi's news or hymns and things like that, I tend to accumulate the news and one big pile, and then I just let it all out once a week, that kind of thing. But I think with my work arrangements, I'm perhaps being able to do more bite-sized content, and then it's easier for people to follow. So let me know if you guys can hear me okay. This is the first time I'm trying this, so I might be a little bit all over the place. So bear with me. Just give me a second. Nice to see. Well, 8 whole people here. That's interesting. For the 8 people here, is this the first time you're seeing my streams, or have you like watched previous videos before? Hi Vincent, hi King Hyung, and Elijah. Yes, definitely a nice name. Hi Jin Chuan. Just give me a second. Nice, nice Vincent. It's first time. Have you seen my previous videos before, or you just like YouTube happens to just recommend you here? It's an interesting day in the markets today. Fellow Singaporean Malaysian, nice. Oh, Dan Sobey, fellow SoFi investor from Singapore as well. Okay, thanks. Yeah, definitely. I think this is something I would like to do more often. I mean, I, I, I grew up in the era of 2017, 2018 when, everybody was still trying to figure out all this finance YouTube and stuff like that. And at that point of time, I was still teaching in a primary school. And then, I just followed all this. And then I just never, and every time I thought that there would be a good like community of people in Singapore to do this. In the end, it doesn't really pan out. Like there are a couple of people that tried it, but nothing really long term. So hopefully, this is something that we can slowly build over time. And yes, the long-awaited correction. I mean, I hope some of you managed to buy in the $12 range for those of you that have a longer-term time horizon on SoFi. Just give me a second. Let me pull out some of my notes, and then we can get started, and then we see how this goes. Okay. Yeah. Okay. So basically, oh, okay. So basically, I think I want to start off by talking about. I mean, some of these things are actually old news. I plan to put them into a video previously, but like I said, I think the hope going forward is that if I can do this more and more frequently, because I have some new work arrangements now. So because of that, if I can do more bite-sized news at least 2 to 3 times a week, and then we'll start from there and see how it goes. So basically, I think the most recent announcement by SoFi is about this partnership with Ascender. And this partnership with Ascender basically allows them to, go into the loyalty programs and things like that. So that is one aspect of their tech platform that is actually new, because previously we only see it as serving banks and financial institutions. But in the last earnings call, they actually told us that they can actually go beyond the scope of financial institutions, and that is what we have seen happening. And actually, the announcement seems to be quite fast. So they actually have they actually did this deal with Wyndham Hotels where they actually partnered them. I think over here. Give me a second. Yeah, they partnered Wyndham Hotels. So let me see. Okay, so this slide over here, right? It's basically something I took from Wyndham's earnings call. So their CEO basically said that they actually finalized an arrangement to launch a co-branded debit card in the United States hospitality sector, and this is in collaboration with Galileo Financial Technologies, right? So which is owned by SoFi. So this taps into the 4.5 trillion debit card spending market. No, for me, I think when I heard some of the other YouTubers and other people covering SoFi stock talk about this, I think the reactions were quite mixed. Some of them were quite excited. Some of them were thinking that debit card doesn't really have a large market, but we can see over here 4.5 trillion debit card spending market. This is actually quite a fairly big market, and I think at least within the Asian context, because Wyndham Hotels is a fairly global brand. So at least within the Asian context, right, I think a lot of people still use debit card. Like recently when I was walking, I think around Suntec, HSBC was having a roadshow over there, and they were trying to pull people to sign up for their credit cards. And you can actually hear some of the people that walk past, they say, no, I don't want to use the credit cards and things like that. And that is still the mentality within some of the Asian countries. And so, yes, at the moment, I think this partnership seems to be just within the US hospitality sector, or at least first of its kind in the US hospitality sector. But Wyndham is a global brand. Actually, if I'm not wrong, if you stand at Suntec City in Singapore, right, the drop-off point going into the MRT station, you can actually see a Wyndham Hotel over there. I think I took a picture the other day, but yeah. So basically, like I was saying, this partnership with Wyndham, I think the debit card spending market is a smaller market than the credit card, definitely, but it's an area that not many people go after, right? So because of that, if they can have the first mover advantage, that can be a market that eventually becomes very profitable for them. So actually, you can actually see the onboarding, at least for non-financial institutions, is quite fast. It's at least probably around 6 months, because it says that the debit card will be available within our digital ecosystem by the peak of the busy summer travel system. So I would presume that's July, August, that kind of timing. And so, like I said, I was doing a little bit of research about how big the opportunity is for the debit card market in terms of travel and hospitality. The global hotel industry is around a $500 billion annual industry. This is not just for debit card spending. This is just in general the hotel industry. And Wyndham basically has 9,000 over properties, right? So that gives SoFi users plenty of redemption options. Anyway, if you're wondering how I summarized all this, I actually put all this into Grok, because I do subscribe for it. So I put all this into Grok and then ask them to come up with a quick summary that I can use as a PowerPoint slide and things like that. So in terms of debit card spending, debit cards account for over 80 billion transactions yearly. So that is trillions of dollars in spending. And the rewards card that basically links the debit card can help to capture a fair share of this volume. So like I said, this might not be a big market compared to like credit cards and things like that. But because not many people are moving or going after this particular market, if SoFi can maintain a strong foothold in that, this can become a very profitable segment for their tech platform as well. I think in the last video that I actually posted about SoFi, or especially in the previous earnings, I think Anthony Nodo also mentioned how the possibility for SoFi to actually branch out instead of just serving financial services companies and things like that. They can branch out into other sectors as well, and so we can actually see that happening. And I think that is quite important for the whole AWS or fintech thesis to play out, because without the ability for them to scale their platform into various sectors of the finance industry, not just within the financial institutions. I think it's very hard for them to claim to become the AWS of fintech. So this is a step in the right direction. I think the revenue recognition over here will take some time, because if the whole debit card program is going to be only set up by the summer, which is around July and August, that means we can probably only see revenue recognition in this aspect of their business probably sometime in Q3 or Q4 of this year, right? So in the first 2 quarters of the year, I would presume that in terms of the revenue from the tech platform, it should still stay more or less what we have seen in the last couple of quarters lah. Okay, so when I went to take a look at this SoFi partnership with Ascender, they actually have Ascender itself serves many clients, and I think a lot of them we are quite familiar with. For those Singaporeans, even OCBC uses them, and Standard Chartered as well, right? So OCBC, Standard Chartered uses them. So these are big companies. HSBC, like I said, uses them as well. Barclays, all the big banks, even Grab uses them, right? So I presume that is because Grab has a financial services arm, their bank, right? GXS with Singtel. And so things like that. And I think we can see Ascender is actually quite a big name in this space. And what they do is that they basically help link up all these loyalty card programs. Okay, and so the second thing I want to talk about when it comes to SoFi, and something that is additive to their business, is this $700 million of securitization of the loan platform business volume. Now, I think we are very familiar by now with the loan platform business, which means SoFi uses its underwriting capabilities to help other companies underwrite their loans. SoFi doesn't hold these loans on their balance sheet. In fact, the companies hold them on their balance sheet and basically pay SoFi a fee. So this is basically a very low-risk, capital-light business for SoFi. And so what SoFi has done is something like an infinite money glitch, right? So basically, what they do is, they have a sorry, let me see. Okay, so if, let's say, company A, they go to SoFi and they get SoFi to originate a loan for them. Okay, they get SoFi to originate a loan from them from the loan platform business. Okay, my handwriting it's much harder writing here than on paper, but yes. Okay, so they go to SoFi, they get a loan originated on the loan platform business. Now, this loan is held onto the company's balance sheet, right? This loan is actually held on the company's balance sheet, not on SoFi's balance sheet. Now, what this securitization of the loan platform business means is that these loans that the company are holding on their balance sheet, SoFi actually helps them to sell off the loans to earn the spread, right? And so once they do that, they actually can take that money and come back to SoFi and then sign another deal with SoFi for the loan platform business. So it becomes an infinite money glitch, right? So the company goes to SoFi, loan platform business, sells off the loan. The company receives more money. And they go back to SoFi to originate another loan through the loan platform business. At least that's how I understand how this works, right? So if you can see over here, so it provides co-contributors with meaningful liquidity to support their ongoing investment in the loan platform business. So this is something that, the company comes to you, you help them originate the loan is held on their balance sheet, you help them sell off the loan, they get the money, now they have this new pile of money, they come back to you, use your service again. So basically, SoFi can just basically rinse and repeat. And as long as the credit environment is strong, as long as there's still demand in the debt market, I think this is something that will be additive to SoFi's overall revenue, especially the financial services sector. And I think this is something for me that actually makes up for the lack of growth in the tech platform. Now, I think one of the things that I want to talk about when it comes to understanding the debit card program and understanding this loan platform business, and why is it important that if one company can come back to SoFi 2 or 3 times within a year to redo their loans and to refresh their loan book, how does that actually benefit SoFi? Because I think we have to remember that SoFi's ultimate aim is to become a one-stop shop financial services platform, right? And so because of that, all these debit card services and all that, each individual aspect of their business, each individual arm of their business may seem small as a standalone, but what it does is it actually brings in members from different points of this flywheel. So some members may come to SoFi's platform because of their loyalty card program with Wyndham Hotels. Some members may actually not qualify for a loan within SoFi's credit box, but because they qualify for a loan in another company's credit box and that company is SoFi's partner in the loan platform business, what happens is that SoFi is actually able to onboard them through the loan platform business without having to take on any risk on their balance sheet, without having to take on any risk of them defaulting on their loans. And at the same time, while the other company that SoFi is working with, actually they hold the loans on their balance sheet, this member can still use the rest of SoFi's products as well. So the more times all these companies come back to SoFi to originate loans through the loan platform business, it brings a greater awareness to SoFi's brand. It brings more members onto SoFi's platform. So to me, I think the loan platform business is actually key in SoFi getting a hybrid multiple. I think when we use the term hybrid multiple, I think a lot of people think of it as you need to have a tech platform and then you have the banking multiple. And so a combination of these two will be called the hybrid multiple, right? So I think at the end of the day, that is one way to look at it. And at the moment, the problem is, from what we have seen, or at least SoFi's management has told us, that because, I think fintechs in general are having a tough time. It's not just Galileo that aren't able to sign clients. You can actually see that all throughout the different companies like Marqeta and things like that as well. And so because of that, all they're doing is they are just pivoting their business. And in fact, when they pivot into their financial services business, this is actually a higher margin business than the tech platform, right? So you can see over here, this is what Anthony knows. We are starting to scale our loan platform business, which is generating margins of around 50%, slightly north of that. Now, this, again, you have to remember that this loan platform business is categorized under their financial services brand, right? Oops, sorry, spelling mistake. Financial services. So because this is under financial services, and they earlier on in this dialogue, basically, I think Nodo told us that financial services has been operating at around 45% margin. And if the loan platform business is operating at north of 50% margin, what this tells us is that as they scale the loan platform business, financial services margin will actually go up closer to 50%. So why is this important? Because everybody has been so focused on the tech platform. But the tech platform, yes, it has healthy margins, but it's only in a 30% range. So as an investor, sometimes I'm always thinking, do I want SoFi to have a tech platform just for the sake of the tech platform, or do I want them to earn more money? So imagine if they run Galileo, they have 3, 4, 5, bigger financial institutions on Galileo's platform, which is exactly what we want. The problem is that because the margins here are in the 30% range, every dollar that they make through the tech platform, only 30 cents go down to, I think they're talking about contribution profits over here. So only 30 cents go to contribution profit, right? Whereas in the loan platform business, within their financial services business, every dollar that they make, 50 cents actually goes down to the contribution profit. So actually, it's not so much about what business that will actually, I think what I'm trying to say is that it's not about the type of business that actually gets you that multiple. It doesn't matter whether or not that contribution margin comes from tech or whether or not that contribution margin comes from financial services. And I think at the end of the day, I think what is important is that their margins are ever expanding, financial services or tech platform, whatever the source is, as long as we see their margins continue to expand, that is how they get the hybrid multiple. And so just a couple of things also came out when I was talking about SoFi. One of the things I saw was this Upstart macro index. At first, I didn't really understand what was this 1.5 and things like that. And actually, it was coming down. You can see over here, right? It was coming down for a while, and recently that ticked up again. And so basically, if you zoom in over here, into the fine print right at the bottom, it basically tells you that the Upstart macro index estimates the impact of the macroeconomy on credit losses for Upstart-powered unsecured personal loans. So what does this 1.51 number means? So they give you an example. If you see the number 1.25 in a given month, it suggests that the default rates are 25% higher than the long run average. So now when we are seeing this number at 1.51, it means that the default rates, at least for Upstart, is actually 51% higher than the long-term average. Now, the one thing I want to say is that, yes, I think some people are a little bit concerned when they actually see this number, but I think SoFi has proven time and time again, that the quality of their borrowers, the quality of the SoFi members is much higher than that of other companies like Upstart and Lending Club. So to me, this is just, yes, an indicator of a broader market. But if you take a look at their revenue over the last couple of years, I think I have shown it previously. Let me see if I can find it. But it's basically showing you, the difference between Upstart and Lending Club's revenue. That at the end of the day, despite the high interest rate environment, while Upstart was affected, while Lending Club was affected, SoFi was the only one that managed to actually pivot their business and to grow their revenues even in a high interest rate environment. So to me, this might be symbolic of Upstart's how the macro environment affects Upstart's business, but that's not necessarily going to be true for SoFi. So that is something that we have to pay attention to moving forward. Now, at the same time, I want to bring up inflation. Why am I bringing this up over here? It's because I think when you look at SoFi's projection for 2025, I think a large part of it is down to their conservative assumptions of the macro environment. Now, in terms of inflation, we can see it coming down, which means that we can actually expect more than 2 cuts. I think SoFi is pricing in somewhere between 1 to 1.5 cuts, right? I think they're pricing in somewhere between 1 to 1.5 cuts. But if I'm not mistaken, right now the market is actually pricing in around 3 cuts. And today, I think because of the announcement of the 172,000 jobs being cut, largely due to a federal layoff and things like that, I think a lot of people start to expect the Federal Reserve to cut rates starting from I think May of this year. If I'm not wrong, later I'll pull up the data, but I'm pretty sure that right now, I think the chances of a May cut, I think, rose all the way up to 45-50%, something like that. That's what I saw earlier in the day. And so because of that, if we're getting more cuts than what SoFi expect, it stands to reason that their business will actually perform better. Now, it might, the only thing over here is that actually SoFi actually expects a 5% unemployment. Okay, SoFi expects a 5% unemployment. If you look at the unemployment data currently, the last data came in, we are about close to 4%, right? Over here, we are close to 4%. So technically, we have room to run from 4 to 5%. And in terms of unemployment. Okay, so I think what this means, it tells us that yes, although the federal, I think like Elon Musk with Doge and things like that, they're trying to cut jobs in the government and all that. Whatever you think about that, to me, all I'm interested in is how it affects SoFi. For me, is if it drives up the unemployment rate, does it go past this 5% mark, right? Because I believe there's this, basically over the years, I think I hear this quite often. I don't exactly know the exact source of where this comes from, but it tells you that if the unemployment rate increases by a full percentage point, it doesn't stop there. It usually increases by another full percentage point again, which means unemployment will go up to 6%. Now, if that actually happens, right, then I think SoFi's guidance may come true for the whole year. Then their conservative guidance may actually come true if we get unemployment of above 5%. But if this, rise in unemployment is actually quite, in a sense, transitory, because Elon Musk is just cutting jobs now, earlier on in his tenure in Doge and things like that, and the extent of it, maybe it goes to 4.1, 4.2, maybe even 4.5%. Then actually SoFi's projections are actually relatively conservative compared to the macro environment that we have. So I think this unemployment number is something that we really have to pay attention to. I think the non-farm payrolls came out yesterday, right? That was 77,000. So I think what is coming out tomorrow? So the ADP report basically was 77,000 yesterday, and I think non-farm payrolls, that will be tomorrow. And then I think from what I understand, I think people are expecting over 100,000 jobs, but I'm not too sure whether or not we will get there after the ADP numbers yesterday. So this is something that we'll have to pay attention to. Yeah, so Nelson is correct. SoFi is guiding 1.5 cuts, so not 1 cut, so 1.5 cuts. I think either way, right now, if I'm not wrong, the market is pricing in 3 cuts. Let me see if I can find this. Okay, let me see. I think it's over here. Is it here? All right, let me see how. Okay, I'm so sorry. How do I share screen over here? Oh, okay. Stop sharing. I think this is the one. Uh, okay, is this correct? Yes, I think this is it. So you can see, like right now, the market is not pricing in a March cut, right? If I'm not mistaken, it's not pricing in a March cut, right? So there's only a 7% chance of a cut in March. But if you go to May of this year, 7th of May, in 7th of May, you actually see that there's a 43% chance of a cut, uh, and 3% chance that they actually cut 50 basis points. So this is what I mean by there might be there's actually more cuts already priced into the market than what SoFi has actually guided for. And so because of that, even if the unemployment rate rises to 4.5, 4.6 because of all the cuts that Doge is doing, I'm actually not too worried in terms of the conservative aspect or the conservative guidance actually playing out. I actually do think that that is really the bottom line. In fact, if SoFi actually meets their conservative guidance, I would be quite disappointed for the business in 2025 unless we really do see a recession. Okay, but at the moment, the indicators are not really showing recession. It is showing some weakness in the economy and things like that, but it's not really showing definite signs of a recession. So that's not something I'm actually going to be too worried about. Okay, so let me go back to my screen. Let me see. Okay, so all this to say that at the end of the day, I want to talk about SoFi's member growth projections, because if you take a look at their conservative estimate, SoFi's estimate, right? SoFi's estimate is around 2.8 million members. Okay, if I were to actually use that, and you can see from the numbers over here, if I were to actually use these numbers, 2.8, which means I add around 700,000 members per quarter net, right? So with 700,000 per members net, you can actually see this is quite I would say it's still not too slow pace of growth, but it's actually slower than what I'm actually comfortable with. I would expect them to be in a year where they're telling us that we are actually going to be driving revenue growth. I actually hope to see this number actually be a little bit higher, above 30%. So how I actually get to this 33 to 34% number, I'm going to show you the Excel file that I always tend to pull up. Oh, this is actually more complicated than I expect. I don't know how people always seem to do this so seamlessly. Give me a second. Stop screen sharing again. Where's my Excel file? My goodness. Did I not open it? No, this. Wait, sorry. I think this is Hymns. This is not SoFi. Where's my SoFi's Excel file? I think it's over here. Yeah. Give me a second. This is Hymns. SoFi is over here. Correct. Can you see the numbers? Or is this too small? I can't tell. Let me turn on my own screen. Okay. I hope you can see. I don't know why my stream is not really turning on here. Okay, but basically, right, I hope you can see this. Otherwise, I'll try and zoom it in a little bit. This if you can see that, if you can take a look at their member growth over the last couple of quarters, let's just start from 2023 over here. You can see their member growth at, as the base of members get bigger, it gets harder to maintain that high level of growth. So if you can see over here, I think you can, there's a drawing tool, right? You can see over here, right? They were growing members in the mid 40% range in 2023. Uh, Even at the start of 2021, right? And then after that, it starts to slow down a little bit just in the last couple of quarters. And so, because of that, I don't actually expect them to slow down even more going into 2025. I expect them to at least maintain the mid 30% range for a couple more quarters. So, you can see over here in Q3 and Q4 of 2024, the numbers here is 34.7% and 34.3% year over year. So, basically, because of that, that's what I'm using. Right, you can see I basically expect 33 to the 33 to 32.5%. I think what I'm quite surprised with is when I use some of these numbers, right, how much they actually change the overall number. You can see this first column over here, the Q1 20. If we just expect 33% growth, right, you actually get less than 700,000 members. So you can actually see, this 33.5, I didn't just put it there, for no reason. It's because SoFi has already told us that they're minimally going to do 700,000 members per quarter. And I do think that Q1 might be a slightly slower quarter at the start of the year. I'm not too sure how many people, hyped about opening bank accounts and things like that. So 33.5% year over year growth, and then slowing down to, I would say slowing down, but it's actually around 33% for the rest of the year. That gets us to around 13.5 million members, 13.4 million members at the end of the year. So that is where I'm coming from over here, as I make these assumptions for my valuation. And all I'm saying is that, and the reason why I'm redoing this valuation is that I think a lot of people over the last couple of weeks are a little bit concerned about SoFi's price action and whether or not they actually can get to the 20 over dollar range. And I'm going to show you that even with conservative guidance, right, SoFi is actually growing into a more and more robust business that is not fully dependent just on member growth. That even if they do get 2.8 million members added in 2025, and I think the only way that happens is that they intentionally do it, right? It's like the start of 2024. If you remember, at the start of 2024, they were guiding for 92 to 95% of lending revenue compared to 2023. Everybody thought that, that was not going to be the case. That was not possible. How can lending come in so slow? And the matter of the fact is that SoFi actually intentionally came in at that level. It's not because their business were operating at that level. They basically intentionally hindered themselves to come in at that level. Could SoFi be doing that for member growth, which is why they get guided for 2.8 million? Could be. That means that they expect, to be able to pull on other levers like revenues per member and, cross-selling of other products to increase revenue growth. But unless they actually come out and say that to us, that's not something I'm going to be assuming, because Anthony Nodo has been on record to say that, the target for SoFi is to be able to grow members between the 800,000 to 1 million members per quarter. Thanks. Clap my dog. Wow, okay. The dog looks really, really cute. Is that a Dachshund? It's like the sausage dog, right? My friend has one. So cute. Okay, back to the analysis. Where was I? Oh, I got distracted by the dog. Okay, I need to go back and share my screen. Oh, it's a golden retriever. Okay. The face looked really, really skinny for a golden retriever. I love a golden retriever. I think my aunt's golden retriever, when I was really young, I think I was 12 or 13, I took it for a walk. It basically pulled me along the park. So, yeah. But I really, really like golden retriever because we actually when I was younger, I used to stay in Australia. So we actually shipped one back from Australia to Singapore for my aunt. Yeah. All right, so where was I? Okay, so like I was saying, right, SoFi's own estimation is that they're going to grow member count by 2.8 million members. So 2.8 million members would put the new members or the net new members per quarter at around 700,000 mark. So how I actually get these numbers over here is basically just, adjusting the growth rates, right? So just by adjusting the growth rates, we get the number. So you can actually see that if SoFi actually hits their projections, the members growth for in terms of a year-over-year basis, it'll start at 33% at the start of the year and decelerate all the way to 27.8% at the end of the year. My own assumption is that they'll stay closer to the 34% mark, right? So somewhere around here. So they'll end the year. I think earlier on, that number that I was using over there was 13.4 million members. Here I have 13.5, but it's more or less in that ballpark figure when I'm doing my estimations. Okay, so basically, what I've done, I've just taken a screenshot so it's easier for you to see. So I'm going to zoom it in so you can actually follow over here. So in terms of members, if we use, 33% to 34% growth throughout the entire year, SoFi will end the year with around 13.5 million members. So this is actually an addition of 3.4 million members, right? Which is more than their 2.8 million that they guided for. Now, in terms of the products per member, all right, products per member is over here. Now, if I want to be extremely bullish, I can actually say that they can go past the 1.5 products per member mark. Actually, by right, they should be going past the 1.5 products per member mark, because Anthony Noto said it should stay at 1.5 all the way until okay, when he said that in June of 2023, he actually said that for the next 12 to 18 months, we'll stay at 1.5, right? So that suggests that after 12 to 18 months, they should start to increase that. Okay, so you ask, how do I see SoFi increasing products per customer? So for example, I think in the fireside chat last year, UBS, I think Chris LaPointe actually pointed out in terms of home loans, right? Actually, only 2% of SoFi's entire members and member base is actually signed up with a home loan with them. So 2% of 10 million. I think that's what, 200,000? Is that 200,000? 2%, 10 million, right? 200,000. Yes, 200,000. So which means that they have a large market to go in just by addressing the members that are already on the platform, just by going after the members already on the platform. And I think what makes it an interesting proposition for SoFi to do something like that is that, because the members are already on their platform, they don't actually have to pay another customer acquisition cost, right? So that means you just pay the cost to acquire the customer one time, and then this customer is already on the platform. And because every additional products that they use on your platform is additional revenue without having to pay a customer acquisition cost. Okay, so how do I see SoFi increasing the products per member? It's by cross-selling a lot of their current products. So a lot of people actually come in just by taking on a personal loan and things like that. So I think you can actually see over the course of the last 2 quarters that management has already talked about cross-selling other form of loans to their existing customers. So if you come on with a personal loan, especially if you have a good track record, your cash flow is strong. SoFi knows that your cash flow is strong because they already have your data with them. What SoFi is then able to do is to come to you and say, hey, we noticed that you already graduated, you're perhaps going to get your new house. Do you want to take your home loans with us? Or if you want to refinance your loans, you can actually refinance your home loan with us. Yes, the cost per customer acquisition should drop as it scales up, definitely, for sure. I actually did this analysis on HIMS. I'm not too sure whether I'll have time to go through it today. But otherwise, maybe over the weekend, if I can fire up a stream, I will talk about HIMS over the weekend as well. But basically, it's much easier to count the customer acquisition cost for HIMS than it is for SoFi, and to estimate that lifetime value of a member, right? And I think another thing that Anthony Noto was talking about, I think I should have this screenshot over here, otherwise I'll share it. If you take a look, you just give me a second. Let me pull out the data for their SoFi Invest. Where is SoFi Invest? Have you all seen the 10Q recently? SoFi Invest. Where is it? So apart from cross-selling home loans, right, they actually do have a large opportunity to actually cross-sell in the financial services segment. Sorry, for those of you in the chat while I'm actually finding this, is the mic clear? I can't really tell, because on StreamYard, it tells me that the mic that is picking up my voice is actually through my MacBook. But on my computer, when I'm looking at it, my input actually comes from my mic. So I'm not too sure whether or not StreamYard is just being weird and not detecting my mic. Because when I look at my system settings in my MacBook, the input actually comes from my mic. So I'm not really sure. Give me a second. Let me pull this out. Okay. Okay, let me share this. Okay, if it's all right, we'll continue. If you can't hear me or anything, just let me know. Okay, so basically, what I want to point out is over here, you can actually see what Anthony Noto said in the fourth quarter earnings, right? Is that SoFi Invest can scale to become just like SoFi Money. So if you take a look at the platform, in fact, in 2023 to 2024, in fact, 2022 to 3 to 4, over the last 2, 3 years, you can see there's not much growth in the SoFi Invest platform, right? 2022, there were 2.1 million products there, 2.38 million products in 23, and 2.5 in 2024. So this constitutes to only a 6% growth. However, in SoFi Money, it's currently growing at 51% year over year, despite having over 5 million products. And so Anthony Noto has already told us that, this year, one of the areas that they're reinvesting into is to actually boost their SoFi Invest platform in terms of the product offerings that they have. If they can bring back crypto onto the platform and things like that, eventually, as this administration sets out all the crypto regulation, then this is something that SoFi can actually look to cross-sell members into. So if and Anthony Noto has already told us what to expect in terms of SoFi Invest. He says that it can become as big as SoFi Money. So you can see over here, at the very least, they can actually double in terms of the number of products that they offer on SoFi Invest. So if you are asking me whether or not SoFi still has room to cross-sell, SoFi really still does have room to cross-sell. I think over the last couple of years, it has been about customer acquisition. They have acquired a fairly decently sized, amount of customer base. I think when I was doing one of my analysis in a previous video, if I can find it, I'll link it down below if you haven't watched it before. I was saying that just using very big high level estimates, that there could be somewhere between 25 million to maybe maximum 30 million people in the US that fits SoFi's credit range. And so because of that, having a 10 million member on their platform is actually not too bad. But especially now that, having the loan platform business and things like that allows them to target members outside of this 20 to 30 million, high net or Henry kind of high earners not rich yet, correct? That kind of members. So basically, I think at the end of the day, SoFi's business is growing in stages. It has been getting members, and it knows that right now, if it only goes after the Henry, the high earners, those that are not rich yet, these kind of people, the growth in terms of member count may start to slow. Because of that, they actually start working with other partners to actually continue to add to that flywheel. Now they have partnerships with Wyndham hotels, people that goes through Wyndham for their debit card programs and their rewards programs and things like that will come on board as a SoFi member. People that have taken on a personal loan can come on board SoFi, not through their loan platform, and then through their loan platform business, or through just directly getting a loan from SoFi. So now there are various ways for people to come on board, and then because of that, as they continue to build out their invest business, as they build out their credit card business, these people that are already on SoFi's platform can adopt all these other products without SoFi having to pay a second customer acquisition cost. Right? Okay. Well, it's been 45 minutes. I didn't even realize that. Okay. Let me see. What was I? So okay, so the assumption here for me is 3.4 million members added by the end of 2025. Products don't go above 1.5, so it stays around 1.6, which is where it is currently. It just increases 0.1 per quarter thereafter, right? So in terms of the revenue per product, okay, the revenue per product is over here. we are assuming $47. Why $47 is that because right now we are actually currently doing around $46 and a couple of cents above $46. So I just assume that we can do $47 as we continue to scale the loan platform business. And then in terms of the tech platform, the numbers that you see over here are actually, I admit they're extremely bearish. This was actually done without considering, how Wyndham will actually affect them, and all these other partnerships that they can have like Wyndham. But basically over here, the first 2 quarters of the year, I'm only expecting an 8% year-over-year growth, much less than their own estimates. And the reason for that is that because the tech platform has been the one component of their business that every time they give guidance on, or in the last couple of quarters at least, they tend to miss. So I think they don't really fully have a accurate grasp of at least the environment that we are in terms of fintech, right? So and then towards the end of the year, as they recognize revenue from Wyndham Hotels and other partners that are perhaps not in the financial services sector, then we get a 10% year-over-year growth. And so that is how we get these numbers over here. Now, I do think that sometime in this year, we are definitely going to see them sign a large financial institution. Like I think a lot of people in the community speculate that it could be Citibank. And if it is Citibank, that is actually that is something that is very exciting because it's one of the bigger banks and it's a bank I actually use as well. It's a bank that I use their credit cards, right? So this is actually exciting for me, and to see how that changes on the back end and whether or not that affects my experience. And so because of this, I do think, but I think Anthony Noto has also been very clear in stating that that I don't think we'll see a large part of the revenue that is being recognized by all these deals in 2025. Most of it will be recognized in 2026, which is why I have all these very bearish assumptions. Now, I think when I post these videos, people always come and say that, hey, why are you so bearish on your assumptions and things like that? I think my whole point is that I'm not trying to be bearish on the company, but if my bearish assumptions still take me to a valuation that makes sense for me, then isn't that even better, right? Everything else becomes a bonus thereafter. So just with these assumptions, 3.4 million members, right? Less than 1.5 products per member, $47 of revenue per product, right? And tech growing at 8 to 10% for the whole year. Okay, that takes us to around $3.7 billion in terms of revenue, which is around slightly above 42% year-over-year growth. Net income, and then this is the diluted shares, around 5% dilution, depending on how that works out for the rest of this year. I don't expect to have too heavy dilutions. If you use a P ratio of 70, which is what it was priced at previously, you basically get a share price of around $23.72. If you use a price to sales ratio, then I think I'm using 10 times over here, around 10 times. If I'm using 10 times price to sales, you get around $30.80. So if you get an average in between these two, right, on average, this will give you $27. Now, earlier on, so I wouldn't be, so for SoFi to get to $27 by the end of the year, that's a double from where, it's more than a double from where it is today. I think today it's around $13.06 from what I see. Okay, so basically, I think one of the things that, oh, nice Excel, thank you. Okay, so yeah, so I think one of the things that I actually noticed is that when I was playing around with the numbers, you can actually see earlier on I was talking about how SoFi can was actually projecting for themselves to actually only add 2.8 million members. So if they only add 2.8 million members, that means that by the end of the year, right, their member count will be around 12.9 million members on the platform. Now, if you notice, I keep everything else the same, right? The products per member is the same, the revenue per product is the same, and the growth of the tech platform is the same. Now, if SoFi actually hits this 2.8 million member growth, you can actually see it doesn't really change the valuation of SoFi. Over here, $23.30. Over here, $30.28. Again, I go back and compare for you. This is $23.72 versus $23.31. So you can see as they become a bigger and bigger company, they have more and more levers for them to pull in order to generate revenue for the company. And it doesn't just come down to growth of subscribers anymore. I think previously the member growth was very important for them, because that's how they actually manage to grow their revenues despite having a high interest rate environment. The more members that they can get onto the platform, that we see a very positive correlation in terms of their revenue trend. But what we're seeing over here is that even if they only add 2.8 million members onto the platform, but if they can actually scale up in terms of the number of products adopted by each member, if they can scale up the revenue, the way that they monetize each of these products, there are different levers for them to pull in order for them to reach their valuation. So even if I take these two numbers, you still get an average valuation of somewhere between $27. So because of that, even SoFi's conservative estimations in terms of the member growth, right, actually gives us still a fairly decent valuation over here. I think the only thing is that if you look at the EPS here, we are expecting 33 to 34 cents, which is actually what I'm expecting for the full year of 2025. I know the guidance now has included, all the income tax that you need to pay at 26% income tax and things like that. But I think let's see how that turns out. I still think that even with the income tax, perhaps we are getting closer to 30 to 31 cents of EPS, and even then, there is still something that is more than what SoFi has been guiding for. And we know that SoFi has a track record of always beating their own guidance and then raising guidance in future quarters. So this is something that I actually hope to see. Yep, I do think I think you're right. 2026 will definitely be the big year of share price growth. For those of you who are still in the chat right now, thank you for the 16 of you still hanging out around here. I think I cover a couple of companies on this platform. I do HIMS, I do SoFi, where I've covered Grab, Enphase, AMD, and things like that. Is there any other particular companies that if you actually want me to look into, depending on my time, I think especially in the later part of March or early April, I might be able to look into some of these companies. Oh yes, S&P 500 membership will definitely be a critical change. Yeah, but I think the price point that they need to hit is $18 per share and maintain that for I think 90 days or something, one whole quarter. Is it 30 days, 90 days? I can't remember. And then they can get included into the S&P 500. Yeah. So I think with that, let me see, is there any market news that I want to talk about? I think the only thing that I have that I want to talk about that is not SoFi related is basically something to do with the markets and the whole reason for this live stream and things like that. How many of you actually saw the news this morning of China's response to the tariffs announced by Donald Trump? AMD and HIMS, yeah, for sure. Actually, I have already more or less prepared the HIMS one, but we've already gone on for 50 over minutes, and my HIMS analysis is still a little bit lacking. Let me show you why it's already here already. Actually, I already have it here. Okay, before I talk about the Donald Trump thing, let me just bring up HIMS over here. I mean, HIMS did very well. I know in my last video when I talked about HIMS, right, I got a lot of comments, pretty angry comments saying that, oh, HIMS will never drop 30, 40, 50%. And I released it at a very, very apt timing because I released it on the Thursday before semaglutide was actually removed off the shortage list. In that video, I actually said that, HIMS could drop 30, 40, even 50%, right? If that happens, true enough, that happened, as well as, the earnings. Actually, after the earnings, I bought more on the dip. So, I'm a happy buyer in the 30s. Basically, one of the problems I had, or why I'm still not too keen on talking about this now, is that because this over here is something that I look at, okay, and I still haven't fully made sense of it yet. So basically, what you are seeing over here when it comes to HIMS is how I used to measure their marketing efficiency. Because my impression of HIMS all along previously, before I started actively looking into it, it was a company that was heavily marketing driven, which means that if they don't market, they cannot have a revenue, and that is not the kind of business that I want to invest in. I like to invest in businesses that it's basically self-marketed, right? As they can decrease marketing spend, but once they decrease marketing spend, the number of subscribers that come onto their platform doesn't decrease as well. So that's something I actually like to track. So I think a lot of the Oh, is it you Tavis? Oh yeah. Tavis. I know he got into him. Actually, I got into him slightly before him. So I got in around the $12 range. I think that was my first buy. Like when it dropped all the way from 24 to $12 last year, that was my first buy. And then after that, I bought it up along the way at 18, 20 something, and things like that. Yeah. So I'm glad you managed to buy during the dip. I mean, I have covered calls on him. I sold covered calls on him for $75, 70, $75, something like that. And it's printing, right? I think I sold it at $12 and it's now only worth 60 over cents today. So, you know, that's that. I think for him, I think one of the issues that I have is that I'm not fully uh, sure whether or not my methodology of measuring their marketing efficiency is really accurate. You can see over here what I've done. It's just basically I've just taken their marketing spend each and every quarter as a percentage of revenue. So you can actually see, 46, 46, 45, 46. So that has decreased over the years. Uh, Actually, if you look at the actual spend, you can't really say it has decreased because it dropped from 51 to 46%. Yes, it's a 5% drop. I would prefer to see this below a 40% mark. But okay, that is something that we'll discuss in a future video. But one of the reasons why I'm not so keen on talking about this right now is because I still need to think through this portion of the presentation. And I'm just putting it out there first, and then I'll see how I can address it in the next video. But basically, over here, what I've done is marketing costs, divided it by the number of new members added. Once I divide this by the new numbers added, what we get is the customer acquisition cost. So you can see this has actually gone up. Now, during the earnings call, at first I was quite concerned about this, but because this was because I'm still a relatively new investor to him. So I've only held this position since August of last year. And because of that, when I listened to the earnings call, what I realized is that the management has told us that every time we launch a new product, we'll ramp up marketing. So it's actually normal for these kind of bumps in terms of marketing spend. It's nothing abnormal, and over time this will come down gradually. And I think what I was very happy to see is actually the bump in terms of the monthly online revenue spend to $73. Right, I think my previous estimate was around $65 to $70. I didn't even think that they would break the $70 mark, but we have done that. So because of this bump in terms of the online revenue generated, the payback period actually came down to 1.39 years. So that was my calculation. But over here, they actually show us a different calculation. I'm not too sure if you can see. It looks blur on my screen. Like, I'm not sure if it's blur for you. And I do think that HIMS is also one of these flywheel companies, and I really like what the management say, that the way that they grow their business is by expanding the number of verticals that they can serve and they've made a couple of purchases recently, which basically expands their capacity, expands their ability to personalize the solution. And I think to me, it's the personalization of the medication that is the real bull thesis for HIMS. But anyway, I'll just talk you through this, and then I'll probably do a more detailed one over the weekend. You can see how they actually calculate this, right? Is that basically per member marketing spend per member is around $113. Now, in the first quarter that this member is onboarded onto HIM's platform, they basically spend $69. Thereafter, they spend 110. Goodness, if any students are watching this, they're going to kill me. 69, 110, that's how you're supposed to write it, right? Plus ones, tens, hundreds, okay? 131, and then 156. So you can see just by doing the numbers over here. Am I right? Oh my goodness, this is so embarrassing if it's wrong. I think it's 457. Oh shit, I hope I'm correct. 9 plus 1, 10, 17. Correct, right? Okay, I think so. $457. So you can actually see the payback period is less than a year. And what they're using is actually gross margin. Or gross profit, sorry. So they're using gross profit to count. I'm using revenue to count. So that's the first difference, right? Which is why they actually talk about gross profit being one of the most important metrics for them. So, okay, so this is how they count. I've been using revenue, they're using gross profit. Now, by using this, what it tells me is that even if I take $457, I divide by 12 because that's the full year. So 457 divided by 12. What's 457 divided by 12? this works out to around $38 per month. Am I right to say that? In terms of gross profit. So each member or each new member generates around $38 per month in gross profit, which doesn't really make sense for me, because if their gross profit is over 70% and online monthly revenue is $73, so does this mean that over time this will scale up even more? I would think that it would scale up even more. I'm just wondering whether or not this is the best. Is there a better way for me to represent it? Yeah. So basically, like I said, I know it's quite confusing. There's a lot of thoughts going through my mind. Basically, I'm using revenue to estimate the efficiency of the payback period. What they have done uh, is to actually use gross profit. So that is something I have to change. I'm not going to use revenue anymore. I'm going to be switching and using gross profit to estimate the payback period. And then I can't get to this $113 dollars per member number, right? Because I'm going to bring you again. So sorry, I'm going to stop screen sharing. Where's my hymns one? Hymns. Hymns is over here, I think. Okay, so you see, the what they actually gave us was Q1 2024 numbers. Now, Q1 2024, it's over here. Over here, this exact number. So we basically added 172,000 new members onto their platform in Q1 of 2024. And they say the cost of acquisition is actually $113 per member. Okay, so if I take 172,000 times 113, if I actually take, okay, sorry. So you can see 172,000 new members. You need to remember this because I have to switch between screens. I'm using my iPad to actually show you. Okay, so why I say I'm having a little bit of trouble working through this and to see whether or not my metric is the best is, number one, like I said, gross profit versus revenue. So if anything, I should be changing to using gross profit as well. Second thing that I'm not very sure is that they actually tell us they added 172,000 new members. But then once I multiply this by the 113, you end up getting somewhere around 19.4 million in terms of marketing spend to attract a new member. But in their Q1 of 2024, you can see that the marketing spend is closer to 130 million. So I'm not very sure where does this come from. I mean, it definitely includes the salaries of the people probably in the marketing development and some of the things that they put out and things like that. So I'm not saying that all these are directly attributed to must be directly attributed to gaining new members, but it's still quite a fair way from the number that we have. So I need to find some sort of correlation between that, but they don't actually give this number. They don't actually give this number very often, right? I think it's not a quarterly thing that they actually give this number. This is because at the end of the year, they're trying to show the efficiency in their marketing. So of course, as an investor, when I look at this, I feel very confident in what the management is doing. It's just that, the nerd in me that wants to actually track this number is having a problem to reconcile some of these things. And I need to have a little bit of a think through before I feel a bit more confident in putting things out. Yeah. All right. I think we'll call it a day for now. It's 12 a.m. over here in Singapore. I'm heading to the gym, then I'm heading to bed. Right. We are gonna get some renovation works done in the house, so I need to be up fairly early tomorrow. So I'm heading to the gym now, and then I will try and fire up a stream on the weekend, either Saturday or Sunday, about hymns, and then we'll see how this goes. And I'm hoping to make this a more regular thing, especially on the weekdays as well, market opens and things like that. The ambitious side of me wants to do market close, but market close in Singapore, it's 5 a.m. And I really doubt that I can wake up at 5 a.m. every single day. I think if there are big earnings during earnings season and things like that, I will definitely do that. But I think apart from that, we'll stick to market opens. Perhaps one a second stream later on for the Asian markets, for those of you who are in Singapore and in Malaysia and things like that. All right, so thanks for your time, and I will see you either Saturday or Sunday, but we'll get a schedule up soon. Okay, thank you for your time, and I'll see you again in the next one. Bye.